Hi, Jim Gore from Thor Wealth Management. Today I want to talk about why it's important to look at history but not bank on it. And what do I mean by that? Well, if you look at what happened back in 1999, and this is looking at the NASDAQ 100 or the QQQ ETF versus the federal funds rate. And what you saw was back in 1999, the Federal Reserve actually started raising rates back in May, June of 1999. And as they were raising rates, the QQQ actually increased, and it had a 50% increase in that value. It was until the very end back in March of 2000, where we saw the federal funds rate with a 0.5% increase from 6% to 6.5%, that finally the NASDAQ QQQ broke down. This is a totally different story from what's happening today. If you look at what's happening today, and especially year to date, you're seeing that the federal funds rate we know has remained stable. As a matter of fact, the Federal Reserve has not yet taken away liquidity. They're going to do that probably next month. But what we're seeing is that even before the Federal Reserve is raising interest rates, we're seeing that the Standard & Poor's, the SPY, which is the S&P 500 index, is down about 10%, and the NASDAQ so far year to date is down 15%. Now, so this is showing that you just don't rely on what happened in the past, because we're seeing the market correct before the Federal Reserve is raising rates. But it's not only in the equity market. If you look at the fixed income market, and this is looking at the TLT, which is the long-term treasuries, is down about 7%. And you have the AG, which is the overall market, bond market, is down almost 4%, down 3.8%. So the market is actually anticipating what is happening with the Federal Reserve, and it is impacting the market. So people say, Jim, what are you looking at right now? Is this just a minor correction? Is this going to continue? Well, one of the things that is concerning to us right now is what's happening with the volume. And this is looking at the S&P 500, the SPY, the ETF. And what you're noticing here, if you look at where the arrows are, back in January, when the market started going down, you actually started seeing volume increase on those down days. And then when the market bounced back a little bit, you saw that the market was going up, but volume was actually going down. That's not a good sign. And if you see here what has happened the last couple of weeks here, the round circle, you can actually see that when the market has had up days, the volume has been very light. On down days, the volume has been heavier. Why is this important? This is telling us that people want to sell more. There's more sellers than buyers out there. And so this is saying to us, from a volume perspective, what is happening right now is that this correction is not over, and we expect it to continue regardless of what happens with Russia and Ukraine. As always, if you have any questions or current concerns, reach out to us on our website, or join us at LinkedIn, YouTube, and also Facebook. We'll talk to you soon.